Welcome to the Hamilton Project and its program. Today's discussion, which as you know, on promoting financial well-being in retirement. Before turning to the program, let me just say a few words about the Hamilton Project. Most of you are probably familiar with it, but just as a reminder, for those who are not, that'll be new information. The Hamilton Project started about 10 years ago. Peter Orszag, myself, Roger Altman, a few other people. And we are not an institution. We are an organization of policy experts, former public officials, business people with a strong interest in policy, academics, and we are organized as an advisory council, which then operates with a very small but extremely good staff that reaches out to people around the country who are, in their judgment, best qualified to provide papers or engage in discussions on the topics that we hold events on 5 or 6 times a year. We've been guided since our beginning by a bedrock belief that economic policy should serve the purposes of growth, broad-based participation in the benefits of growth, and economic security. And we also believe that these objectives can be mutually reinforcing rather than antithetical, as is so often argued. As an example, broad and ongoing increases in standards of living require growth, both because of a larger pie to split and also because of tighter labor markets. And conversely, growth requires broad-based participation in the benefits of growth in order to create demand, in order to create public support for growth-oriented policies, and very importantly, to provide workers with the resources to invest or expend on education, good nutrition, housing, health care, and the other requisites for productivity. We also support market-based economics, but equally, we support a strong role for government to serve the many purposes that markets, by their very nature, will not serve. It should be obvious from all the comments I've just made that we are truly non-ideological, and we truly are pragmatic within the context of a framework that I've just described. Today's program concerns one of the objectives of the Hamilton Project, long-term retirement security. More specifically, we will focus on workers and how they achieve financial security in retirement. The financial landscape for retirement, as all of you know, has changed dramatically over the years. We have greatly rising longevity expectations, which is good, but on the other hand, also creates its own issues. Increased dependence on individual savings, changes in the way employees save, and greatly heightened strains on federal, local, and state social safety net programs. Our current situation, when you put all of that together, is not viable, and it is not sustainable for the long term. We should have, and we do have, debates about how to address these issues, but what we do not have is action. It is an absolute necessity, and inevitably it will have to happen, that our political system will face its issues at all levels, federal, state, and local, and to deal with these issues. And that can only happen when there is a willingness to engage in principled compromise across policy and political divides, and that certainly is in large measure absent at the federal, state, and local levels today. I strongly recommend that you read the paper that you received on your way in. It's called 10 Facts About Financial Well-Being in Retirement, and I think that rather very succinctly but effectively addresses the enormous changes that have taken place in the environment for financial security in retirement. Today's program features 2 papers, one dealing with private savings, the other with long-term care. The panels will discuss the respective papers, and then they will talk more broadly about the issues with regard to retirement security. As I said a moment ago, life expectancy, as we all know, has increased greatly over the last 50 years, which is very good, but it poses enormous challenges with respect to retirement. To take just one example, long-term care is hugely expensive, but private insurance tends to cover relatively little of that expense. The result is that older Americans, in many cases, have to spend their own assets, and then when they deplete those assets, are dependent on Medicare and Medicaid. That in turn puts extra pressure on those already strained programs, and those programs, the healthcare programs, as you know, are central to our own sustainable long-term fiscal position in this country. Secondly, more Americans rely on investment-driven retirement vehicles than ever before. Roughly 13% of private sector employees still have defined benefit plans. In their stead, as we all know, have come 401ks, IRAs, and other instruments. The payments are more variable, and very importantly, these plans require workers to determine how much to contribute, how best to invest the funds, and at what rate to spend down in retirement. To make sensible decisions about these issues, people have to have a relatively significant level of financial literacy. In a well-regarded survey, only 1/3 of the respondents ages 25 to 34 were able to correctly answer questions about fundamental investment concepts like compound interest, diversification, and inflation. And in that same survey, people ages 55 to 65 were obviously much closer to retirement. Only about half were able to answer those questions. Thus, financial literacy is an enormously serious problem in a system that is now so dependent on private savings. Third, many state and local pension funds are significantly underfunded, and in most cases, relatively little is being done about it. And the federal programs, retirement programs, face similar problems. In 1960, there were 9 active workers contributing to Social Security for every retiree collecting benefits. Today, and there are various ways of measuring this, but at least the way that we measured it, there are 4 workers for every retiree, and that number is declining. There are many thoughtful approaches to addressing these challenges with respect to Social Security. But what is the unavoidable truth that we don't like to face is that action is needed. And of course, Medicare and Medicaid, as I've already mentioned, face their own substantial and growing financial distress, even with the decline in the rate of increase of healthcare costs. And once again, we come back to the question of the unwillingness of government at the federal, state, and local efforts, for the most part, not entirely, but for the most part, to engage in principled compromise to make the difficult choices and decisions that we ultimately are going to have to make, because the system as it is today is simply not sustainable for the long term. Finally, as I said earlier, many Americans rely, more Americans than ever rely on personal savings. But most families can't meaningfully increase their personal savings because we have had stagnant or close to stagnant median real wages for a long period of time. And thus economic security, as well as growth and broad-based participation in the benefits of growth, are tied to meeting the pressing but complex challenge of achieving robust and ongoing rate of increase in median real wages. We are joined today by really a remarkable group of authors and panelists, deeply experienced and thoughtful, and a highly distinguished keynote speaker who I'll have the privilege of introducing in a moment. They will help us all think through these complex issues. In accordance with the long-standing practices of the Hamilton Project, I will not go through the resumes of our distinguished participants. They're in the materials that you received on the way in, but I will recognize the keynote speaker and the panelists as I now outline the program. Our program will begin with remarks by the Honorable Tom Perez, Secretary of the United States Department of Labor. He is, as you know, extraordinarily well respected, and we are deeply, deeply grateful to him for joining us, since secretaries tend to be rather busy, and it was nice of him to take this time to be with us. Our first roundtable will address challenges and opportunities in the private long-term care insurance market. Those will begin with comments on his paper by Professor Wesley Yin of UCLA. He will be joined as discussants by Tom McInerney, President and CEO of Genworth Financial, Alice Riven, Director of the Center for Health Policy at the Brookings Institute and a member of the Advisory Council of the Hamilton Project, and Howard Glickman, Resident Fellow at the Urban Institute. The discussion will be moderated by Ben Harris, Chief Economist and Economic Advisor to the Vice President and former Policy Director of the Hamilton Project. After a short break, we'll focus on a new proposal to reform retirement savings accounts, authored by Professor John Friedman of Brown University. Professor Friedman will be joined by Jim Paterba, Professor of Economics at MIT and also President of the National Bureau of Economic Research, and Deborah Whitman, Chief Public Policy Officer at ARP, which I have had the privilege of belonging to for a long time. The panel will be moderated by Melissa Carney, the director of the Hamilton Project. Let me close by thanking the people who developed the intellectual construct for this program and brought it all together. Melissa Carney, I've already mentioned, Kristen McIntosh, Managing Director of the Hamilton Project, Jane Doko, Policy Director of the Hamilton Project, and Brad Hirschbein, Visiting Fellow at the Hamilton Project. Let me also thank our enormously talented, hardworking staff, without whom all that we do would be impossible. Now, it is my honor and privilege to welcome to the podium our keynote speaker, who has a long, distinguished, and highly regarded record in public service, as you can see from your materials. He is also universally respected for the work that he has done in his current position as an extraordinarily effective Secretary of Labor, the United States Secretary of Labor, Tom Perez, and we are, as I said before, deeply grateful for you being with us.
Hey, good afternoon. It's an honor to be here. Thank you for your kind introductions, Secretary Rubin, and most importantly, thank you for your distinguished service to our nation. We owe a great debt of gratitude to you. And to my friends at Brookings, it's always great to be back here. I always enjoy coming here, and I'm particularly honored to be speaking here at the Hamilton Project, which has done so much. And when you were introducing and giving the history of the project, it felt like it was 30, 40 years old as opposed to 10 years old, because you have such a record of accomplishment. Today's conversation is really about what it means to be middle class in America. That's what we're talking about, because retirement security is such a critical pillar of what it means to be middle class in America. And when you think of the Labor Department, if I did that Pavlovian, tell me what's the first thing you think about, I think a lot of people would talk about our advocacy on behalf of workers, and I'm very proud of that. But we're just as vigilant and aggressive when it comes to fighting for the interests of those whose working days are behind them. It's actually right there in our mission statement, if you take a look at it. And I quote, "To foster, promote, and develop the welfare of wage earners, job seekers, and retirees of the United States." And as Secretary Rubin correctly points out, the retirement landscape has really changed dramatically in this country. This is not your father or your mother's retirement. It used to be in the old days of Ozzie and Harriet that you worked for the same company for decades, and you'd retire with a handshake, maybe a pen, a party, and a pension. And you got that check every month, and you didn't have to worry about who was taking care of it when you were working, because you had a fiduciary who was doing your job for you. And those checks came in the mail. You remember that thing, the mail? They get delivered to you, things like that. And oftentimes it continued to provide benefits for your spouse after your death. This is a new era. Ozzie and Harriet has been replaced with Modern Family. And if you ask a millennial like my kid, my oldest is about 19 years old. If you asked her what a defined benefit plan was, I'm confident she would know about as much as that as she knows about a typewriter. And as you correctly point out, we've gone from 78% of the workers with a defined benefit pension in 1975 to 33% in 2012. 401ks, as you know, and IRAs are very vulnerable to that market volatility, and workers are now responsible throughout their careers for managing their own assets and making decisions that will affect their financial security for the rest of their lives. And so, to put it slightly differently, the work of the Department of Labor in this space has never been more important, because we have so much work to do. We have a new paradigm, and we need to help them as much as we can. And that's exactly what we do. The president outlined what he calls his three-legged stool of retirement security. And I don't want to talk too much about the first one, even though it is so critically important, and that is Social Security. we could have an entire session on Social Security and what we need to do. And the president has been very clear, very unambiguous in his belief and support for the time-honored Social Security program. And he has outlined in detail things that need to be done to make sure that the greatest generation will have Social Security and their grandchildren as well. And the financial health, I will say, though, about the Social Security system and Medicare, and I serve on the Board of Trustees for the Medicare Trust Fund, it cannot be separated from the health of our labor markets, because the best thing for these programs, as you correctly point out, is a growing economy that continues to create more jobs. During the recession, obviously, the trust fund suffered because fewer people were paying into the system. Today, a resurgent economy has generated 12.6 million jobs over 63 consecutive months, and it's putting those programs on a sounder footing. And just about everything I do as labor secretary, investing in upskilling so that people can advance their careers, fighting for higher wages by advocating for a minimum wage or putting out overtime regulations, advancing the economic interests of women by closing the pay gap and the participation gap, getting more women in the workplace through progressive policies such as paid leave. All of these have the benefit of funneling more money into the Social Security system. And all of these have the benefit of preparing people for a more prosperous retirement, because it goes without saying, if you're making more throughout your working years, you're going to have a more prosperous retirement. And that is why the issue of wage inequality is so front and center for this president. Social Security, and I could not be here without reiterating this, would be bolstered further if we had comprehensive immigration reform, because the CBO and others have determined that you move people out of the shadow economy and into the sunshine, and you will extend the solvency of the trust fund by 2 years and reduce the 75-year shortfall by nearly $8 trillion. So a strong economy in which everybody is participating naturally benefits Social Security. And this is another way in which, as the president often says, America is at our best when we field a full team. Now, the second and third legs of the stool, which absolutely need fortification, are personal savings and employment-based savings. We need to tighten the bolts on both of those. And both the federal government, state government, the private sector, and our partners play a critical role. And there is no magic bullet solution moving forward. At the federal level, given the challenges we have with Congress right now, the president has been using his executive authority and the ingenuity of folks in his administration to do everything we can do. And the president took an important step forward in 2014 with the establishment of the MyRA program to help the 60% of people who have no job-based retirement savings vehicle at all. MyRAs are designed by the Treasury Department to help Americans kickstart their savings in a way that's simple, safe, and affordable. If you enroll, money is automatically put into your account as long as your employer uses payroll direct deposit. It's portable from job to job. The investment is backed by the U.S. Treasury. Costs nothing to open an account. And you can design it to fit your budget, contributing as little as a few dollars a month. The president wants to move further with this idea, and the 2016 budget proposal includes a plan to automatically enroll Americans without workplace retirement plans in an IRA. And he has also proposed tax cuts for small employers who offer auto IRA. As with so many of the issues that we work on at the Labor Department, including wage security and paid family leave, leadership at a federal level is an important complement to our efforts. And the synergy between what we're doing at a federal level and state initiatives that are designed to enhance retirement security is essential to our progress. Several states have been stepping up and talking about this issue, and not simply talking, but acting. They are playing their traditional roles as incubators of innovation, launching efforts to encourage state-based options for workers whose employers don't sponsor a retirement plan. California and Illinois, in particular, have stood out for their leadership, and others are following suit. For instance, Oregon just passed a bill, and it's on its way to the governor's desk, and I have every confidence that she will sign it. And we have been in communication with a number of these states, learning more about their approach and providing technical assistance. What these states have told us is that they need to find new and creative ways to help their residents save, especially people who don't have other access to a job-based retirement plan. I'm very excited about these state-level efforts, and I want to do more to help them. we want to make sure that we can encourage and facilitate them by removing barriers preventing them from flourishing while preserving absolutely essential consumer protections. I believe that the action that's occurring and the innovation occurring at the state level is one of the most important things that's happening in this retirement discussion at the moment. You mentioned financial literacy, Secretary Rubin, and financial literacy and education are so critical to making sure that we keep this steady stools steady and indeed standing. And financial literacy and education have been an all-hands-on-deck enterprise. It's been a joint venture between the feds, state and local governments, private sector, faith leaders. Where I live in Maryland, in Prince George's County, a group of faith leaders started what they call the Collective Banking Group, which was an organization that was premised on the notion that people will talk about their finances with trusted opinion leaders. And often those trusted opinion leaders are their ministers. And so finding the people where they are, building those bridges of trust. We see so many people doing so many innovative things. And you know what? I know as the parent of three, young people are not the most diligent savers. I've got one kid who believes that if you make $100, that means you can spend $100 that week. It's not quite that simple, I'm trying to explain, frequently without success. And so we're continuing, and I see so much innovation that's dedicated at talking to millennials and talking to them in a way that they understand. So there's an app out there. If you go out and go to Starbucks and pay $3.48 for a cup of coffee, it will round up to $4 and it will deposit the 52 cents in savings. And the number of times that adds up. It's a nice, remarkable, simple, elegant utilization of technology to help young people understand the power of savings. And what we also have to understand as we look at the issue of savings is that it's not only young people who aren't saving enough. There is substantial research showing that there are alarming racial disparities in retirement account balances. Across all income levels, African American and Latino families don't have as big a nest egg as their white peers. The gap gets smaller as you move to higher income brackets, but even among people earning $120,000 or more, in 2010, Latinos had 72 cents and African Americans 71 cents for every dollar saved by white households. We see it among federal employees as well. Both Ariel Investments and the Office of Personnel Management have looked specifically at participation rates by minorities in the Federal Thrift Savings Plan. The OPM study found that even among workers at the same salary grade, minorities are less likely to contribute. And when they do, they contribute less. It is critical that we understand and address these disparities, especially as our nation grows more racially diverse and the millennial generation gets into the workforce. Ariel Investments and the Labor Department's own ERISA Advisory Council have looked at these issues and have a host of recommendations for closing these gaps, both for young people and for people of color, including the greater use of technology, enhanced efforts at financial education and outreach, using automation as much as possible, and taking advantage of social media and other available communication tools to get the message out. I think that's so critically important, and we're going to continue to work in this area. And I've seen so much remarkable work at a grassroots level. Just today, I met with an individual, John Hope Bryant. He's the CEO of Operation Hope, which was founded in the aftermath of the 1992 riots in Los Angeles. It's America's first nonprofit social investment banking organization. They call themselves the Nonprofit Private Bank for the Working Poor, the Underserved, and the Struggling Middle Class. In addition to providing internships, apprenticeships, and entrepreneurship training, they do remarkable work in economic education and financial literacy empowerment for young people, especially young people of color. He speaks, and I met John again this morning, and he speaks of what he calls civil rights, the next phase of the civil rights movement, where underserved communities can attain financial dignity, access to the resources they need to thrive in a free enterprise system. And so this work will continue. I applaud the work under Rich Cordray and the Consumer Financial Protection Bureau. We have an alphabet soup federal agencies that are dedicated to this task and making real progress. And working together, I think education and outreach can be a critical effort and a critical role as we move forward. But what happens when workers and families do all the right things, when they're conscientious about saving, when they're frugal and prudent, and when they smartly put aside immediate gratification to think long-term, and they still have the promise of a dignified retirement snatched from them unceremoniously? How can we keep them from being victims? How can we make sure that the hard-earned money that you have put away goes to you? This is a question that we have been dealing with at the Department of Labor for some time, and I appreciate the dedicated work of our career staff. And this is a question that is front and center today. And let me explain what I'm talking about. And the best way to explain it is to tell you a story. Regrettably, this is not fiction. This is reality. Merlin Toffel did everything right. He was a veteran of the U.S. Navy, an electrician. He and his wife, Elaine, raised their 4 kids in Lindenhurst, Illinois, and they instilled in them the middle-class values that are befitting of the greatest generation. They loved to travel, and they worked hard and took care to save wisely. Over 4 decades, they built an impressive portfolio with Vanguard. Merlin was at the helm, managing the account actively, and his wife, who was an accountant, was keeping the books. But life happened. Life took its toll. And Merlin was diagnosed with Alzheimer's. He frankly passed away just a few months ago. When Merlin could no longer manage their finances, Elaine made an appointment at a local retail bank. This was the bank they had used throughout their careers, throughout their lives. They trusted this bank. And the bank's investment broker told her to liquidate the Vanguard portfolio and sold them variable annuities to the tune of $650,000. Elaine trusted that advice. She thought it was in her best interest. She really thought so, but it turns out not to be the case. But those variable annuities charged nearly 4% of the investment. So they had a $26,000 annual fee. That you could buy a pretty darn good car each year for $26,000. And if they needed to access the money right away, as all too many families face when our loved one is in decline, a 7% surrender charge would cost them more than $45,000. And in the end, the conflicted advice cost them more than $50,000. And that does not factor in the remarkable mental anguish that they had from having to haggle and deal with this situation while simultaneously dealing with his declining health. And his story is tragic, but I regrettably must say that it's not unique. Conservative estimates by the Council of Economic Advisors and some of the best economists in the history of the United States once worked and directed the Hamilton Project, I'm told. And the chair of, he told me to say that, by the way. Actually, that's not true. But conservative estimates by CEA place the cost of conflicted advice at more than $17 billion annually. Our economic analysis at the Department of Labor shows that conservatively, the amount that savers would benefit from our rule, and this is only based on a slice of the IRA market, and the CEA analysis was only based on a slice of the market as well. Our analysis shows that consumers would have a $40 billion benefit over 10 years if we eliminated conflicted advice in this one space. And for families like the Toffels, folks who've done everything we ask of the American middle class, I think the stakes couldn't be higher. And that is why we, a few months ago, released a proposed rule addressing conflicts of interest. And the underlying principle of our rule is very simple, and it's rooted in very basic common sense. If you want to give financial advice, you have to put your client's interests first and not your own. That's the basic premise of our rule. Completing this rule is one of the single most important things that we can accomplish in the remaining 577 days. I got a note on my desk. 577 days till the weekend, January 20th, 2017. And this is on the top, this is at or near the top of the list of things that we have to do to help strengthen and grow the middle class. Because if you think about it, and you put this in perspective, I'm the youngest of 5. I've got 4 siblings. They are all doctors, and I am a lawyer. I promised them I would never be a plaintiff's personal injury lawyer. I did keep my promise. I mean no disrespect to those who are in that line of work. But I think about this in the context of the fact that 3 of the most important decisions, or types of decisions that people make in their lives, are medical, legal, and financial. And for doctors like my siblings and lawyers like myself, the rules are clear. I've got to put your best interest first. If I go to the doctor and I'm diagnosed with cancer, she's not going to tell me what's suitable. Or if she does, I'm not going to be satisfied with that. I want to know what's best for me. I don't want to know what's suitable. But that is the challenge in the financial space. Some people have taken already an oath to act as a fiduciary. The individual that my wife and I use is a fiduciary. So he has an obligation to put his customers' best interests first. But you know what? So many people don't. In fact, the majority do not. And now this is not a challenge, and it's important to say this. I don't believe that the challenge here is that we have a bunch of people who have malice in their heart. That is not it. There are undeniably bad actors in this space, undeniably bad apples, just as there are doctors and lawyers who are undeniably bad apples. But to me, the crux of this issue is that there are good people operating within a structurally flawed system, a market that sees the interests of the advisor and the firm all too frequently misaligned from the best interest of the customer. So the singular goal of this proposed rule is to align the two, or simply put, we want to create an enforceable best interest standard because the existing regulation is completely anachronistic. It was created 40 years ago, back in the Ozzie and Harriet years. Now we have literally $12 trillion in the IRA and the 401k markets. And so we need to get into the modern ages of our regulation. And so we recognize that this regulation is a sea change for some. And that is why when I started this job almost 2 years ago, we slowed the process down. The original rule was proposed back in 2010, and it was withdrawn. And I made a commitment to slowing it down because I'm a big believer when you regulate that the most important thing you can do is build a big table and make sure that every voice is heard and that you go through your enterprise with humility. Because you know what? If you think you know it all, then you're not going to get the job done because there are so many people out there who know so much. And that is why we spent so much time before we put this proposed rule out. And that is why the proposed rule we put out a few months ago reflects the feedback we have gotten because there is no one-size-fits-all template for serving clients' best interests. And that is why our proposal provides the guardrails of the best interest standard, but does not involve putting in place straitjackets that unduly limit what people can do. So we provided various carve-outs and exemptions to give the industry that flexibility. The proposed exemptions from the prohibited transaction rules would broadly permit firms to continue common fee and compensation practices as long as they adhere to basic standards aimed at ensuring that their advice is in their clients' best interest. This is the work that we are doing, and this is the work that we are continuing to do, and the collaboration that has marked our entire process will continue. We've met with representatives of all of the major financial industry groups, financial services CEOs, large and small, and representatives of employers who offer retirement plans to their workers. We've met with consumer advocates and civil rights groups. We've worked extensively with our government partners, including but not limited to the SEC, whose expertise continues to be very critical. Because successful rulemaking, as I mentioned, cannot happen in a vacuum. And we've put that feedback into action. A number of people were concerned we were going to ban commissions. This rule does not ban commissions. A number of people wanted to make sure that we clarified the line between education and advice. And we have tried to do so. And we continue to take feedback on what we should be doing. And I'll tell you what's most interesting and exciting to me in this process of listening and learning has been the recognition, the increasing recognition at the highest levels of the industry that the best interest standard is the right thing to do and the smart thing to do. Leaders like John Thiel at Merrill and Brian Moynihan at B of A have come forward to say that the best interest standard should be the rule. Now, they have questions about making sure that the implementation and the operationalizing of that are done properly, and we continue to have that feedback. But they are understanding, and they are not the only ones saying that the best interest standard is the way to go. Jack Bogle, the founder of Vanguard, has been one of our most outspoken allies, 64 years in the business. And I remember one day when he said, I've been in this business for 64 years, and I've learned that when you put your customers first, it's great for your customers, and it's great for business. And we've also heard from smaller, more entrepreneurial firms who serve people with lower net worth and more modest portfolios. Companies like Financial Engines, Wealthfront, Personal Capital, and Rebalance IRA, they all provide personalized advice while already embracing and adhering to a fiduciary model. Christopher Jones, who's the Chief Investment Officer for Financial Engines, calls this rulemaking, quote, an important step to ensure the quality and independence of the investment advice provided to 401k investors. Bill Harris, the CEO of Personal Capital, calls it a, quote, no-brainer. He adds, if it's not in the customer's best interest, it's not advice. Plus, Harris says, if you give the best advice and do it well, it will redound to the benefit of your firm. And when I talk to firms like these and tell them that the argument that some of our opponents say that this rulemaking will make it harder to serve the small savers, I get one consistent response. Could you give these small savers our email address? Because we're already doing it, and we're doing well at it, and we welcome their business. And the bottom line is, this is a $12 trillion industry. I am hard-pressed to think that folks are going to walk away. As I learned in Seattle, when I was out there on April 1st talking about a new minimum wage law, there was a representative of the Restaurant Association standing right next to me. And she said, you know what? Any good business in America, regardless of what sector you're in, the businesses that thrive are the businesses that adapt. The businesses that thrive are the businesses who understand that customers come first. And the businesses that thrive do that. That applied in the restaurant industry, and it applies here. And I believe that this rule will serve as that catalyst for further innovation in the industry as more firms devise new tools and strategies, assisted by modern software and new technology tools, to accommodate even those with only a few $1,000s to invest. One of my most interesting listening sessions when I went out on this rule was to go to the UK, because I had heard from some that the sky had fallen after the UK had put in place some regulations. And in many respects, their regulations were even stronger than ours. They banned commissions altogether. And I had heard repeatedly that the sky had been falling. And here's what's happened in the UK. There are far more people who are now investing in low-fee index funds. And you know what I've learned in this business is that most people, especially that small saver, their needs are simple. Their needs are served by simple investments. Variable annuities are not the answer for so many people. They weren't the answer for the TOEFLs. And the reason they become the answer inappropriately for so many is because the system is misaligned. And so what we've seen in the UK is that people actually are getting better advice. And I was told that, you know what, there wouldn't be anyone out there to serve clients. Well, during this period that one of the studies looked at in the UK, there were 310,000 old clients who were lost, and they've added 820,000 new clients. Now, I went to law school because I'm not very good at math. But I don't think I need to be a math whiz to figure out that that's a fair amount of addition into the market. And so I bring that up because I think we can do this. If you have the will to do this, you can figure out a way. And we will continue to receive and review every comment that we get. And we've heard a lot of interesting and important concerns. We've heard concerns, for instance, that the additional data retention and point-of-sale disclosure requirements are too cumbersome, challenging to implement, and won't provide significant benefits. And we've received feedback from others who have the opposite view. And we hope to take in that many more comments on this important issue. The reason these comments are so important is because they have already begun to sharpen our thinking about what we should do to make changes to these exemptions. For example, by eliminating any of those provisions I just mentioned, so that the proposal accomplishes its goals in the most simple and least burdensome way possible. The more voices that are heard, the more open, inclusive, and transparent the process, the stronger the rule will be. And I firmly believe, as I said before, that this rule, as we talk about the retirement space, is one of the most important things that we can do at the Department of Labor. Because, the Department of Labor is really the Department of Opportunity. And as I conclude, I wake up every single day with an abiding optimism about the future of this country. I wake up every single day with a hop in my step. A hop in my step that's a function in no small measure of the knee replacement I had a couple of years ago, but a hop in my step metaphorically as well. And I have that hop because I think about the times we are living in, and I think about the mission of the Department of Opportunity. And you think about the 5 pillars, because this is not simply a conversation you're having today and we're having today about what happens when we turn 65. It's about the future of and the very definition of what it means to be a middle class. It's about those 5 pillars, wages so that you can put food on the table, quality education for you and your family, a roof over your head, affordable health care, and retirement security. All of those pillars need to be fortified and strong. And we're in the fortification business. And in order to fortify this middle class, we need to strengthen and protect all of those pillars. And the Department of Labor is involved in so many. And that's why I love my job, because we have that opportunity. And I am firmly convinced if we are to protect the retirement pillar, we need to continue with common sense regulation. There's this false choice that people make. And we've seen it at work in so many contexts. We either have regulation or we have a sound climate for lending or a sound climate for advice. I categorically reject those false choices, just as when I used to do police misconduct work, I categorically rejected the false choice between either protecting public safety or respecting the Constitution. That's a categorically false choice. And we live in a world where all too many things are defined in binary, inaccurate terms. We can build a stakeholder economy where employers take care of their shareholders, they take care of their workers, and they take care of their customers. And we see so many people who understand that the high road is the smart road. Jack Bogle and others in this industry understand that same thing. They understand that innovation is a key to success. They understand that it is an economic imperative, not to mention a moral imperative, for them to make sure they put their customers' best interest first. And it is in their enlightened self-interest, because the high road is indeed the smart road. And so in these 577 days that I have left until the weekend, I will continue our efforts to make sure that everybody has a fortified middle-class existence, including but not limited to the work we're doing here today and discussing today in the retirement space. I know that we have many challenges, and I know that there are many storm clouds, but this isn't the first time in our nation's history that we've confronted storm clouds. And we've always been able to come together because we recognized, and something you said, Secretary, resonated with me profoundly. We recognized historically that idealism and pragmatism are not mutually exclusive. We recognize that principled compromise is not a 4-letter word, and we can recognize that again. And in the work we do every single day to enhance retirement security, we're doing just that. I see points of light across this country. I see flowers blooming across this country. I see innovation in states. I see leaders in the corporate community stepping up and saying, this is what we need to do, and this will be good for our business. Whether it's the conflict of interest rule, whether it's other common sense regulations that help level the playing field for everybody, I'm confident that we can move forward in a productive way. But this is indeed an all-hands-on-deck enterprise, because with the graying of the population, time is less and less an ally. And that is why this convening today could not be more timely. So thank you for having me. I'm sorry that I can't participate in the next conversation with this distinguished panel, but I know that this panel will produce not only dialogue, but action that will help build a better and more inclusive America. Thank you so much for allowing me to speak.